What you're about to hear is going to sound absolutely insane. But I need you to stay with me because the evidence is overwhelming and the timeline is tighter than most people realize. We're not talking about some distant economic theory or a maybe someday scenario. We're talking about a fundamental shift in how wealth is preserved that's happening right now, and if you're not positioned correctly before the markets open Monday morning, you could be watching from the sidelines as one of the greatest wealth transfers in modern history unfolds without you. Let me start with something that should terrify anyone holding significant cash positions or traditional retirement accounts. The dollar's purchasing power has been eroding at an accelerating rate, and what we're seeing now isn't just inflation. It's a systematic devaluation that's being masked by official statistics that don't reflect the real cost of living, increases you're experiencing every single day. When you go to the grocery store, when you pay your insurance premiums, when you look at your energy bills, you know something fundamental has changed. The numbers don't lie, even when the official reports try to soften the blow. Here's what's really happening behind the scenes. Central banks around the world have been accumulating physical gold at a pace we haven't seen in decades. These aren't amateur investors or retail traders making emotional decisions. These are the most sophisticated financial institutions on the planet, run by people with access to economic data and geopolitical intelligence that you and I will never see. And they're not buying gold ETFs or paper contracts. They're taking physical delivery of actual metal and storing it in their vaults. When the people who literally print money are converting that money into hard assets, that should tell you everything you need to know about where they think this is headed. The technical picture is equally compelling. Gold has broken through resistance levels that held for years, and the momentum is building in a way that reminds seasoned traders of previous major bull runs. But here's what's different this time. The fundamental drivers supporting this move are stronger and more numerous than any previous rally. We're not talking about a single catalyst or a temporary flight to safety. We're talking about a convergence of factors that are all pointing in the same direction simultaneously. Think about the geopolitical landscape for a moment. The BRICS nations aren't just talking about alternatives to the dollar anymore. They're actively building the infrastructure to trade outside the dollar system. Major oil producers are accepting payment in currencies other than dollars for the first time in half a century. The entire post-World War II monetary architecture that made the dollar the world's reserve currency is being systematically dismantled, and most Americans have no idea it's even happening because the mainstream financial media barely covers it. Now, before we go deeper into what this means for your wealth, I want to make sure you have access to the information that could protect everything you've worked for. I've put together a comprehensive guide that shows the specific strategies thousands of American retirees are using right now to protect their hard-earned wealth from what's coming. It's completely free, and you'll find the link in the description below. This isn't theory or speculation. These are proven methods that are working for real people in real time. Grab that guide because what I'm about to show you next is going to make you want to take action immediately. Let's talk about silver for a minute because what's happening in the silver market is even more dramatic than gold, and most people are completely missing it. Silver has this unique characteristic where it's both a monetary metal and an industrial commodity. That means it's getting squeezed from both sides. On the monetary side, investors are recognizing that silver is historically undervalued relative to gold. The gold-to-silver ratio has been wildly out of whack, and when that ratio normalizes, the move in silver is going to be explosive. But here's the kicker. On the industrial side, silver is absolutely critical for the green energy transition that governments around the world are mandating. Solar panels, electric vehicles, 5G infrastructure, all of it requires silver, and there's no substitute that works as well at any price point. The supply situation is even more interesting. Unlike gold, which is primarily mined as a primary product, most silver comes as a byproduct of mining other metals like copper, lead, and zinc. That means silver supply doesn't respond quickly to price increases the way you might expect. When silver prices rise, mining companies can't just decide to produce more silver. They're constrained by the economics of the primary metals they're actually mining for. This creates a supply inelasticity that can lead to price spikes that shock people who aren't paying attention. And here's something that should concern anyone who thinks they can just wait and buy later. The physical market is already showing signs of stress. Premiums on physical coins and bars have been elevated for months. Delivery times from major dealers have been extending. These are the early warning signs that the paper market and the physical market are starting to diverge. When that divergence becomes obvious to the broader public, when people realize that the price they see on their screens doesn't reflect the actual cost of getting physical metal delivered to their door, that's when panic buying begins. And once that starts, it feeds on itself. Let me tell you a story that illustrates exactly what I'm talking about. Back when Nixon closed the gold window and ended the dollar's convertibility to gold, most Americans didn't understand what had just happened. They went about their daily lives, trusting that the government and the Federal Reserve had everything under control. But there were people who understood the implications immediately. They understood that once you remove the anchor that ties currency to something real, to something that can't be printed at will, you've fundamentally changed the nature of money itself. Those people bought gold and silver, and over the next decade, they watched their purchasing power not just preserved, but multiplied many times over while everyone else saw their savings evaporated by inflation that reached double digits. We're at a similar inflection point right now. The difference is that this time, the stakes are even higher because the distortions in the system are even more extreme. We've had over a decade of near-zero interest rates and quantitative easing on a scale that would have been unimaginable to previous generations. The money supply has exploded. Government debt has reached levels that can never be repaid in real terms. The only way out is inflation, and that means the systematic devaluation of every dollar-denominated asset that isn't protected. Here's what keeps me up at night, and what should concern you too. The derivatives market built on top of precious metals is enormous. We're talking about paper claims on physical metal that exceed the actual available supply by orders of magnitude. As long as everyone's content to trade paper and nobody asks for physical delivery, the system works. But the moment confidence cracks, the moment a significant number of holders decide they want actual metal instead of a promise of metal, the entire structure becomes unstable. And we're already seeing the early tremors of that instability. The COMEX, which is the major exchange where precious metals futures are traded, has been experiencing unusual activity. Open interest has been shifting in ways that suggest major players are positioning for something significant. Commercial traders, the ones who typically provide liquidity and take the opposite side of speculative positions, have been reducing their short positions. That's significant because these are the insiders, the people who understand the mechanics of these markets better than anyone. When they're reducing their bets against higher prices, they're essentially telling you they think prices are going higher. Now let's talk about something that most financial advisors won't tell you because they don't have a solution to offer. Your retirement accounts, your 401k, your IRA, they're sitting ducks in this environment. They're denominated in dollars, invested in assets that are priced in dollars, and completely exposed to the devaluation that's already underway. You've spent decades building that nest egg, making contributions, watching it grow. And now you're supposed to just hope that the same monetary system that's showing cracks everywhere somehow holds together long enough for you to retire comfortably. That's not a plan. That's a prayer. But here's what a lot of people don't realize. You can actually hold physical gold and silver inside a retirement account. It's called a gold IRA, and it allows you to get the tax advantages of a traditional retirement account while holding real, tangible assets instead of paper promises. I've put together a detailed guide on exactly how this works, how to set it up without triggering tax penalties, and what you need to know to do it correctly. You'll find that in the description below. If you're sitting on retirement savings and you're concerned about what we're discussing here, this is something you need to understand. The guide covers everything, and it could be the difference between preserving your wealth and watching it evaporate. Let me give you another historical parallel that's eerily similar to what we're seeing now. In the late 1970s, gold went from around $200 an ounce to over $800 in just a couple of years. Silver went from around $5 to $50. Those weren't gradual moves. They were explosive rallies driven by the same fundamental factors we're seeing today. Loss of confidence in fiat currency, geopolitical instability, inflation that was officially acknowledged, but actually much worse than reported, and a growing realization among investors that hard assets were the only real store of value. The people who recognized what was happening early and positioned themselves accordingly didn't just preserve their wealth. They multiplied it several times over while everyone else was struggling with stagflation and economic malaise. But here's the crucial difference between then and now. In the 1970s, the distortions in the system were much smaller. Government debt was a fraction of what it is today. The derivatives market didn't exist in its current form. The global financial system wasn't as interconnected and fragile as it is now, which means that when this move happens, and it's not a question of if, but when, the magnitude could be much larger than what we saw back then. We're talking about a potential revaluation of hard assets relative to paper assets that could be the defining financial event of this generation. And it's not just about the price appreciation, although that's certainly important. It's about having something real, something tangible, something that can't be devalued by a central bank decision or a government policy change. When you hold physical gold or silver, you're holding an asset that has maintained its value for thousands of years across every civilization and every monetary system. It survived the fall of empires, the collapse of currencies, wars, depressions, and every other economic calamity you can imagine. That's not an accident. That's because these metals have intrinsic value that doesn't depend on anyone's promise or anyone's guarantee. Let's talk about the supply and demand fundamentals for a minute, because this is where things get really interesting. On the supply side, gold production has been essentially flat for years. The easy deposits have been mined. New discoveries are rare and expensive to develop. The average grade of ore being processed is declining, which means miners have to move more rock to get the same amount of gold. All of this means that supply is constrained and can't respond quickly to higher prices. Meanwhile, on the demand side, you have central banks buying, you have investors seeking safe havens, you have industrial users who need the metal for manufacturing, and you have jewelry demand from emerging markets where gold is culturally significant. All of these demand sources are competing for a relatively fixed supply, and that's a recipe for higher prices. Silver's supply and demand picture is even more compelling. Annual silver production is actually declining in some regions. The above-ground stockpiles that existed for decades have been largely depleted. And remember, silver gets consumed in industrial applications. Unlike gold, which mostly gets recycled and stays in circulation, silver in solar panels and electronics often isn't economically recoverable. It's gone. That means every year we're drawing down the available supply while demand from both industrial and investment sources continues to grow. At some point, that math doesn't work anymore, and prices have to adjust to balance the market. Now, I want to address something that skeptics always bring up. They'll say that gold and silver don't pay dividends or interest, so why would you hold them instead of stocks or bonds? And that's actually the wrong question. The right question is, what good is a dividend or interest payment if the currency it's paid in is losing purchasing power faster than your earning yield? If you're getting a 3% return on a bond but real inflation is running at 7 or 8%, you're not making money. You're losing purchasing power. You're going backwards. Hard assets don't need to pay you a yield because they're preserving your purchasing power, and in environments like we're in now, that preservation is worth more than any nominal return you could get from traditional investments. Here's another angle that most people miss. The financial system is built on confidence. Confidence that your bank deposits are safe. Confidence that your brokerage account reflects real value. Confidence that the numbers on your retirement statement represent actual purchasing power. But what happens when that confidence starts to crack? We saw a preview of this during the banking crisis, when depositors started questioning whether their money was actually safe. The government stepped in with guarantees and backstops, but those guarantees are only as good as the government's ability to make them good. And when the government is running trillion-dollar deficits, and the central bank is the buyer of last resort for government debt, you have to ask yourself how solid those guarantees really are. Physical gold and silver remove you from that system of confidence and counterparty risk. When you hold the metal yourself, or in a secure allocated storage facility where you have direct ownership, you're not depending on anyone's promise. You're not exposed to bank failures or brokerage insolvencies or government policy changes. You have something real that you control, and in times of financial stress, that control is invaluable. It's the difference between hoping the system holds together and knowing that regardless of what happens to the system, you have assets that will retain value. Let me paint you a picture of what Monday morning could look like if you're not prepared. Markets open, and there's news over the weekend that accelerates the trends we've been discussing. Maybe it's a major central bank announcement. Maybe it's a geopolitical development. Maybe it's a derivatives blow-up that exposes the fragility of the paper markets. Whatever the catalyst, gold and silver gap higher at the open. Not a little higher. Significantly higher. The kind of move that makes headlines and gets everyone's attention. Suddenly, people who've been ignoring precious metals are scrambling to get exposure. Dealers are overwhelmed with orders. Premiums spike. Delivery times extend to weeks or months. And if you're trying to get in at that point, you're paying much higher prices and competing with everyone else who just woke up to what's happening. Contrast that with being positioned before the move. You've already got your physical metal. You've already got your gold IRA set up if that's part of your strategy. You're watching the chaos unfold from a position of strength instead of panic. You're not trying to chase prices higher or settle for whatever you can get. You're sitting on assets that are appreciating rapidly while everyone else is scrambling. That's the difference between being proactive and being reactive. And in markets that can move as fast as precious metals, that difference can be enormous. Now, I want to be clear about something. I'm not saying you should put everything into gold and silver. Diversification is important, and everyone's situation is different. But what I am saying is that if you don't have meaningful exposure to hard assets right now, you're taking a risk that most people don't fully appreciate. You're betting that the monetary system continues to function smoothly, that inflation remains contained, that geopolitical tensions don't escalate, that the derivatives market doesn't blow up, and that confidence in fiat currencies remains intact. That's a lot of things that all have to go right. And if any one of them goes wrong, the consequences for dollar-denominated assets could be severe. Think about your retirement for a minute. You've worked your entire life to build that nest egg. You've made sacrifices, delayed gratification, saved consistently, and invested prudently. You've done everything you're supposed to do. But all of that effort, all of those years of discipline, they're vulnerable to forces completely outside your control. Monetary policy decisions made by unelected officials. Government spending that's spiraling out of control. Geopolitical developments that can change overnight. You can't control any of that. But what you can control is how you position your assets to weather whatever comes. And hard assets, physical gold and silver, they're the ultimate hedge against the uncertainty we're facing. Let me share one more historical example that really drives this home. During the Weimar hyperinflation in Germany, people who held their wealth in paper marks saw their life savings become worthless. Literally worthless. You've probably seen the pictures of people using wheelbarrows full of cash to buy a loaf of bread. But there were people who converted their marks into gold and silver early in the process. Those people not only preserved their wealth, they were able to buy real assets like property and businesses for a fraction of their real value from desperate sellers who only wanted hard currency. The wealth transfer was staggering, and it all came down to understanding what was happening and positioning accordingly before it was obvious to everyone. We're not in a hyperinflation scenario right now, and I'm not predicting that we will be. But the principle is the same. When confidence in a currency erodes, when the purchasing power of that currency declines, the people who are holding real assets come out ahead. It's not complicated. It's not some sophisticated financial strategy. It's just basic economics and human nature. People want to hold things that have real value, and when they lose faith in paper, they turn to hard assets. It's happened throughout history, and it's happening again right now. The question you have to ask yourself is this: are you going to wait until it's obvious to everyone, when prices have already moved significantly and availability is constrained? Or are you going to position yourself now, while you still can, before the crowd realizes what's happening? Because once the crowd gets it, once this becomes mainstream knowledge, the opportunity to get in at reasonable prices will be gone. You'll be competing with millions of other people who are all trying to do the same thing at the same time, and that's when markets get disorderly and prices can move in ways that seem irrational. I want to emphasize something important here. This isn't about timing the market perfectly or trying to catch the exact bottom. It's about recognizing a major trend that's already underway and making sure you're positioned to benefit from it. The move in precious metals has already started. We're not at the beginning anymore, but we're also not at the end. There's still time to get positioned, but that window is closing, Every day that passes, every new development that reinforces the thesis, every additional central bank purchase, every sign of stress in the financial system, it all brings us closer to the point where this becomes obvious to everyone. And here's the thing about obvious. Once something becomes obvious in financial markets, the opportunity is largely gone. The big moves happen when something is still controversial, when there's still debate, when most people are skeptical. That's when the smart money positions itself. By the time everyone agrees, by the time it's safe and comfortable and your neighbor is talking about it, the easy money has been made. We're still in that window where this is controversial, where mainstream financial advisors are still recommending traditional portfolios, where most people aren't paying attention. But that window won't stay open forever. Let me tell you what I'm seeing from people who are taking this seriously. They're not putting a small percentage of their portfolio into precious metals as some kind of token hedge. They're making meaningful allocations. They're treating this as a core holding, not a speculation. They're buying physical metal and taking delivery. They're setting up gold IRAs to protect their retirement accounts. They're doing the research, understanding the fundamentals, and making informed decisions based on the evidence rather than hope or conventional wisdom. And they're sleeping better at night knowing that regardless of what happens in the broader financial system, they have assets that will hold value. Now, if you've watched this far, you're clearly someone who takes their financial future seriously. You're not content to just follow the crowd or trust that everything will work out. You want to understand what's really happening and position yourself accordingly. That's exactly the right mindset, and it's why I want to make sure you have access to the best information available. For those of you who've stuck with me through this entire analysis, I've got something special. If you're an American retiree with at least $100,000 in any retirement account, you can get an exclusive one-on-one educational web conference absolutely free. No obligation, no pressure, just a detailed walkthrough of how to protect your retirement savings from everything we've discussed here. This is only available to people who mention they watched this video, and it's only for those with significant retirement assets who are serious about protecting them. You'll find the details in the description below. The bottom line is this: we're living through a period of monetary history that will be studied for generations. The decisions you make right now about how to position your wealth will determine whether you're one of the people who preserved and grew their assets or one of the people who watched their purchasing power evaporate. Hard assets, physical gold and silver, they're not a speculation or a gamble. They're insurance against the very real risks we're facing in the current environment. And like any insurance, the time to get it is before you need it, not after the crisis has already hit. The evidence is overwhelming. The trends are clear. The timeline is compressed. Don't wait until Monday morning when everyone else figures this out. Position yourself now while you still can.